Welcome to a special edition of Economics Applied at Jackson Lake Lodge in beautiful Wyoming. With me is Mary Daly. She's president of the Federal Reserve Bank of San Francisco and also a member of the Federal Open Market Committee, or FOMC, which sets monetary policy for the United States. We're here at the Jackson Hole Monetary Policy Symposium. We're both attending, and we're delighted to be in this setting. Behind us, you can see the glorious Teton Mountain Range and a sliver of Jackson Lake. And if you squint, you might even see some wildlife passing by as we speak. So welcome, Mary. It's a pleasure to be here with you in such a fabulous setting.
Likewise, glad to be here and love the view, so it's terrific.
Yes, okay. So you gave a really interesting speech a couple months ago on central bank communications about monetary policy. And I wanted to ask you about that. And just to set things up, I think you started off the speech, or pretty early on, noting that central bankers have a duty as public servants to be transparent about their actions and accountable for them. So I think you took that as a premise. You also stressed that the purpose of central bank communications is to improve understanding of monetary policy. And am I on the right page so far?
Completely.
Okay.
And on the duty thing, if I may just add to that, the American people should expect us to be accountable for our actions, but to be accountable for our actions, we have to be transparent about what we intend. And that those two things go together. I think it's a responsibility of public service. If we do our job well, people understand, they can make better decisions in their lives and even help us with achieving our goals.
Yes. So all that makes perfect sense. I'm bought into that. But as you know well, the best way to communicate about monetary policy is far from obvious and gets into a lot of deep waters. And in fact, the way that the Fed communicates about monetary policy has evolved greatly in recent decades. So can you just kind of recap for us briefly, what that evolution has looked like in the United States in recent decades, what the big changes were and what the reasoning was behind them?
Absolutely. And I think it's useful to start with the beginning of central banking for all countries was communication is bad. Don't communicate. Because if you communicate, you take your tools away. You can't be agile. You won't surprise anybody. And the idea was surprises are what help with transmission of monetary policy. We've come a long way since then, but we started with what I would call toes in the water. So the first thing we did under Greenspan was release a statement, an FOMC post-meeting statement that said, here's what we did. Remember, it was like blowing smoke up a chimney and you had to read it from interest rates.
Back in the late 80s, early 90s?
Yes.
Okay.
That's way back. It's, honestly, for most of the Fed history, communication, zero. It's only recent history where communication has started to blossom and we know how to use it as a tool and we're continuing to learn. So first thing you do, release a statement. The next thing, though, under Chairman Bernanke really, is to start using communication as an effective tool, not just telling people what you're doing right after the meeting, but actually using it as a tool. So thinking about how do I, communicate to the public. Ben Bernanke famously went on 60 Minutes in the financial crisis and said, here's what we're doing, here's why we're doing it, here's why it's important to you. But communication's not just one-off.
This is like this old idea of don't tell people what you're doing or how you reach your decisions. We flipped 180 degrees from that. But what motivated that change? What led to that change?
Well, research, first of all, you're academic, we're both researchers. The scholarship was telling us that we were actually not doing as well as we wanted to because we were surprising people all the time. And, people want to make mortgage decisions, business decisions with a sense of where things are going. If you won't tell them where they're going, it's hard to make those decisions.
So maybe surprise has some advantages, but the people who were being surprised, the businesses
they didn't like it.
They didn't appreciate it all the time.
And I think also the research was starting to reveal that not only is surprising people not maybe the best in public service, but you're actually not even enlisting the public to help along your goals. Inflation is a great example. If they know the Fed's going to work to bring inflation down, then they don't expect inflation to continue to rise, and they will not raise inflation expectations, which actually helps us achieve our 2% target more quickly.
So communication gives you potentially extra tools
exactly
for implementing the kind of monetary policy and achieving the kind of monetary policy objectives you're after.
Absolutely. And does so with less pain and discomfort because people aren't surprised and they're helping along the way.
Okay, and then I want to tie back to something you said earlier, but I think this is part of the thinking as well, that secrecy as opposed to transparency is not very conducive to accountability.
It's not conducive to
Right.
accountability. And you can see this in any part of life, but in central banking, you see it in high relief. A strong relief is that it's not conducive to accountability, which means you're not gaining trust. And if people don't trust you, then what you say doesn't matter. And so you want to be conveying things that people can trust and believe, especially on inflation. We're going to get inflation to target. We're going to do so helpfully and gently so that we don't break the labor market. We want people to know that. Well, then they have to have high trust. That means you have to have high accountability.
Right.
It's the right
So-
thing to do, but it's also the effective thing to do.
So you remind me, George Shultz, former Treasury Secretary of the United States, among many other important roles, said many, many times, trust is the coin of the realm. He was often talking about the national security arena,
Mhm.
international relations, other aspects of economics, but you're saying trust is also the coin of the realm for monetary authorities, because then correct me if I'm wrong, because then when they make pronouncements, it will be credible and people will make decisions based and take actions based on those pronouncements. Is that correct?
Absolutely. That's exactly right. The coin of the realm is the way I often put it. It is the coin of the realm. Ultimately, if you don't have that, then all other things are harder and less effective.
Okay. It is interesting. I mean, you and I are economists, we're professional researchers, but even over the course of my career, you're younger than me, so maybe not over the course of your career, it's just startling the 180-degree shift in how we think about the way the Fed, but most leading central banks nowadays, how they try to communicate about their policies.
Well, I can just offer this. In 1996, I started the San Francisco Fed in September. I'm a new rookie economist. I was told early on, we're an organization that does a lot and says little. And so now we're an organization that tries to do a lot, but says a lot as well. And the balance is, the one we have to always achieve is, to what extent are we saying a lot and conveying a lot? Where's the clarity here?
Yeah, exactly. So that's a great segue to just what I wanted to ask you about next. I mean, there's the issue of clarity, and is that sometimes impeded by saying too much
It is.
and having too many talking heads? So
You
can
know what?
speak about that.
I don't know if it's about the number of people who are talking or the number of things we're saying, but I do think that we have to collectively decide as a group what is our main goal. So I think one of our main goals is transparency, but the second one should be clarity.
Right.
And if we're adding a lot of noise and no one understands what we're saying, I think that's a problem. Or if we're communicating too strongly a view, only to find out that, we didn't have clarity at all, we had the confusion. So communication for its own sake is not a goal. Communication for the sake of the public, that is a goal. And I think
It's a goal.
it's not just too much, it's the quality.
And just to help people appreciate how subtle this is, let's go to the issue which you did talk about in your speech a bit, about precision of pronouncements about where the Fed thinks the economy is heading, where it thinks its own policy actions are heading. That turns out to be pretty tricky. So I want to get your views on that. Is there too much precision right now in the current regime? And maybe I should back up a step and ask you to explain what is the current regime through which the Fed communicates about monetary policies.
So we have many features that we use, many tools. So we release a post-FOMC statement. The chair gives a press conference after each meeting and goes through what the statement meant. 4 times a year, we do the summary of economic projections, where participants project their views on the economy and the interest rate path. And we also go out and speak. I'm talking with you. Many of my colleagues are talking about the economy. So we're all out there conveying. The chair talks regularly. So we're talking about these things. Where the challenge comes, I think, is that the world we're sitting in today is highly uncertain. So for us to be overly precise about what we will be doing a month from now, 6 months from now, probably would be non-additive. To use a non-economist thing, it wouldn't be very helpful. People are like locked into that view only to find out the world evolved differently.
So should I infer from that that you have serious reservations about the current structure of the summary economic projections?
I don't mind them. I think the narrative around them has gotten a little misconstrued. So we send out, I have a phrase that I use regularly, and it's those summary of economic projections are as good as the day they're printed. And what you really want to take from them is how are the participants overall reacting? Because we write down something about the economy and the evolution of monetary policy based on the best information we have and our expectations of how it will evolve. Tomorrow, a different data point could come out, a different shock could hit the economy. We're going to have to adjust. So what is, I think, unhelpful is that gets set up as for strong forward guidance
Right.
when it's actually not meant to be.
Okay, but then should the Fed move away from point forecast and maybe express ranges, or should it have contingent forecasts? Because I know, sophisticated market participants know that monetary policy is contingent.
It's
On
contingent.
what's going to
Exactly.
happen, what data comes in, and so on. But there is this anchoring feature, as I perceive it. You can tell me if you disagree, of the summary economic projections that sometimes leads market astray and sometimes has proved to be a challenge for the Fed to work around. Do you agree with that characterization?
I do agree with that characterization. I think it's been beneficial from a transparency perspective, but the communication of it does get locked in, and then our hands aren't literally tied because importantly, we can react to the economy, and we do. What's tied up a little bit is the communication. And that's back to this idea of how do you convey clarity, and especially how do you convey clarity of how you'll respond in a time period when you don't have perfect clarity about the data. And that's harder. And I think, we're exploring, as the chairman said, we're exploring all types of ways to communicate in one of our monetary policy framework conferences, public conference. We had Ben Bernanke talk about scenario analysis. This is a thing that all central banks, or many of them, are grappling with. How do you convey the uncertainty and the wide range of possible outcomes while you remain sensible enough that a person can follow what you're talking about?
Yeah, the scenario analysis that Ben Bernanke is proposing is a form of
It is.
contingent statements about the future rather than point projections.
It is. And one of the things you'll see, and I'll take 10 seconds here, is that many of us right now are talking about scenarios. If the economy does this and then tariffs prove to be a persistent effect on inflation, this would require this. If the labor market falters, this will require this. If things evolve with a little bit of an effect on short-term inflation and a softening labor market, we'll do this. I think that is the communication. It's very unsatisfying, though, to some people who want point clarity, but point clarity itself can be a distraction.
Yeah, and I'm sympathetic to this moving towards more contingent scenario-based statements about what the Fed plans to do. That just seems like a more grounded recognition of the world in which we live.
I would agree with that completely. And, the FOMC is going to be taking up these issues. We're coming out with our framework review results, but then we'll also continue to think about communication. I think one of the bigger lessons I've learned over my career in central banking is you can never say you're done on communication. There's always a way to get better, to refine the message.
Yeah.
It's also state dependent or contingent. In certain moments, strength and clarity, that precision is required after the pandemic, after the GFC. In other times, sometimes less is more. And that's an important feature.
And the way we communicate is amongst not just the Fed and everybody else, but amongst all of ourselves with the rise of the internet and social media has also changed the landscape for communication.
Absolutely.
So I wanted to tie again two strands of our conversation back on this precision point from a different angle than transparency and clarity, which go back to our discussion about trust. So one argument, and I associate this argument with Larry Summers, I wanted to get your reaction to it, which is too much precision about what the Fed plan is going to do in the future can actually undermine the Fed's credibility and the trust that flows from that, because inevitably sometimes because the world is uncertain, you don't follow through on these point projections, at least. What's your view about that argument?
In the speech you referenced, I talked about how precision after the GFC was really important because it helped us be moving markets to know that we were going to do lower for longer to support the economy. But then we used some of the aspects of that precision guidance in September of 2020, which turned out to be a communications challenge for us. Once the inflation started picking up and was rising so rapidly, we had to offset it with aggressive rate hikes. When I look back on that, I said, what's the lesson we learned from that, from my vantage point?
I wanted to ask you about that, so I already preempted it.
And my lesson there is that really you have to have state-dependent, contingent communication, and the precision we were trying to offer was actually becomes a burden down the road, not in terms of what we can do. As you remember, we raised the interest rate rapidly, so we weren't tied up, but the communication was tied up. And I think you could look back on inflation expectations drifting up and people saying, well, we're just not going to react until unemployment comes down to a certain level. That ultimately taught me that too much precision, even in these times that feel like a complete crisis, may actually be suboptimal, be something you don't want to do. So thinking carefully about what you're trying to do and recognizing you have a lot of uncertainty. I'd say the same thing applies today. The world's very uncertain right now.
Right.
So if we over communicate precision, we're likely to find ourselves at odds with the data.
Okay, so two things. One, I hear you saying, you're actually making a pretty subtle point about precision, which is you're saying that the optimal degree of precision in monetary policy pronouncements is itself state contingent.
It
It
is.
may have been very different in the midst of the GFC than what it probably, according to your view, might better have been in 2021.
Yeah, and let me just offer, I didn't know that back then, but I
didn't
now
know
have
that.
learned that,
So
right? I've learned,
So
and I
have we
think that's
all.
how we all learn, right? Is
Yeah.
that it turns out that it wasn't really great for the moment we faced. Of course, we hadn't had a moment like that since the 80s and 70s, so we didn't know it would come. But you've got to allow yourself the opportunity to plan for all the range of things that could happen.
Well, but how did the Fed? Okay, so you're implicitly, I think, acknowledging, at least with the benefit of hindsight, a misjudgment or a mistake in how the Fed communicated around 2020.
Well, let me say, this is my view. So
This is
just,
your view.
I
I
don't want to
understand.
impugn
I
all my
understand.
colleagues here, but
If
I
I'm
do,
not- if I'm
I
not
do regret it.
misreading,
I
okay.
do regret
So
that
okay.
precision.
So then, how? I want you to tell me, how is it that the Fed got to that point? What was? Do we need internal reforms in the Fed? Do we need just a rethinking of our intellectual frameworks? I want to take it beyond just that particular episode, and what can we learn going forward that would make the Fed more intellectually and adept so that it could engage in the right kind of contingent
So let me,
policy analysis.
I think that's a great
and
question. So let me
pronouncements.
answer it how I've been thinking about it. The first thing that becomes clear, I've worked in the Fed for quite a while, most of my career. What I've learned over time, and we're like all other humans and agencies and academic researchers, we often study and fight the last war. So if the last war was the GFC, then you study and fight what remedies do you have for that. But ultimately, you apply them to something that's completely different. A global pandemic, that's really challenging to do. And so what's the reflection? New shocks can behave differently and leave yourself some latitude. I went back and read how the FOMC, I was there, but it's useful to remind yourself how Ben Bernanke, the FOMC, had charted the course. They didn't do it with a light switch, right? They didn't say, oh, I know the problem,
Right.
let me do it. They did toes in the water. And when you do toes in the water, you learn more over time. I think that's a useful thing.
Yeah.
Stepwise, right? Step
Yeah.
function, kind of test and go. So that's one lesson.
That's when you're operating in a world that you don't fully understand.
Yes.
That's a sensible strategy.
The second, I think, thing that's important to recognize is we were not the only group doing this, but we did it as well, is that we've come out of a decade of low neutral rates of interest, low global inflation, fighting inflation from below our target, trying to push it up. So that gets in your mind as, oh, we want to make sure we guard against deflation that could come out of this situation, as it had come out of the great global financial crisis. But there were also the other side of the risk. We just hadn't experienced them for 30, 40 years.
So let me pick up on that because, I think we were fortunate that Ben Bernanke was Fed chair at a time when an intimate knowledge of what had happened in the 1930s
Exactly.
was inside the Fed chair's head. But I think there's a larger point. My perception, I want to get your reaction to this, is that Ben Bernanke aside, that maybe there's not enough broad sweep historical expertise within the Federal Reserve System. And a little bit more would help us engage in this kind of thinking that you're advocating.
So one
Do you
way,
agree with that
well,
assessment?
I agree with the statement that we need all of us, and I would say academic economists, policy economists, Fed economists, all of us need to really interrogate past history. I think that's a place where any one of us could be more. I mean, if you look at the research publications, I spent a lot of time looking at those. They tend to be from the last war or something new that's happening, AI or something, but no one's going back and restudying the Great Depression until you get something that looks nearer the Great Depression, right? So I was giving talk about Ben, honoring what he had done during that time at the AA meetings. And one of the things I realized is we're the new monetary policy economists studying the old things, and how are they blending the new shocks that could occur
Okay.
with the old history we have. So I think it's a broader call, because ultimately, sitting at the Fed, you can't have expertise across the full range of things you will encounter. And that's why you can't sit in an echo chamber of your own, locked up in a
Right,
room. You have to ask people like yourself, but this is why Jackson Hole is so important, right? We come, we hear from others. You don't see any Fed people up there presenting, except the chair. You see people learning from the debate. So I would call it for all economists and all people who study history. Let's understand more of what's possible and not focus on the last risk, but the full range of risks.
Okay, that's I want to see if there's anything else you want to get on the table now, Mary. We're going to talk again tomorrow, so we have a chance to reflect on Jay Powell's remarks tonight. But anything else you want to leave us with right now?
I'll leave you with this only, and look forward to talking again tomorrow. The thing that's really important is when we do these kinds of postmortems, look backs, people forget that the reason we're looking back is because we need to get ready for the future. And I think it's really important that this remains a dynamic process. It's less about mistakes to just point them out, and more about what do you learn that you can do better with in the future.
Right. We want to do better in the future.
So I look forward to talking.
And this is not just an academic exercise.
It's not.
There's a lot that rides on getting monetary policy, not perfect, that's an unattainable goal, but improving it.
Improving it, exactly.
Okay. Thanks, Mary.
Thank
That was
you.
a great conversation.
That was great. I agree. Thank you.
Mary, welcome back.
Thank you.
We have had the privilege of listening to Jay Powell deliver one of the most important monetary policy speeches of the year, I think you could fairly say. Maybe that's even a slight understatement, here at the Jackson Lake Lodge for the annual Jackson Hole Monetary Policy Symposium. So I wanted to just first ask you, what did you take away from the speech? How did you interpret the message? Going back to our earlier discussion about the importance of Fed communications, how did you interpret the message that Jay Powell was delivering?
Well, the chair delivered a balance of risk speech. He said, here's what's important to us, our dual mandate goals. We're focusing on the employment side of our mandate because we have to balance those risks against the inflation side of our mandate, laid out how important inflation expectations are, how important it is to get into the labor market early, not let it get to a point where it's struggling. And that means we are going to have to make data-dependent trade-offs on our policy. So I thought it laid out a lot of flexibility for us to go forward, depending on how the data evolve.
Okay. That's sort of how I took it, especially beyond the next couple of months.
I think that's right.
That left a lot. It's basically, we're going to see what happens and we're going to behave appropriately. But then let me ask you, and again, this is even more closely connected to our earlier discussion about central bank communications. What does it look like the market? What was the market's interpretation of the speech? And was it exactly in line with your interpretation?
Well, the markets took it to be much more of a commitment, which I think is always, whenever you say commitment in central banking and we didn't make the commitment, it's probably a mistake. But I do think the markets got a little ahead on believing that, a rate cut is right around the corner, maybe at the next meeting. And I think that's because we had a poor jobs market report, a reasonable inflation report that was located with the tariffs and goods inflation, but not much other place. And they probably overestimated what that's going to look like. But ultimately, we're going to get another report on inflation, another report on the jobs market, and we will then have to wait and see how the economy evolves. And as you said, and I agree completely, the chairman left a lot of room for us to react, as we should, to accomplish our goals. The other thing I would ask, Steve, if I may, is that, I don't just look at how the markets react. I actually look at how our boards and councils and public react, and they seem a little more understanding that this is a balance of risks.
Right. That's right. Wall Street is not the economy.
It's not the economy.
It's just a very particular part of the economy that warrants a lot of attention, gets a lot of media attention, but it's not the economy as a whole.
Absolutely.
It's important to remember that. So I very quickly had time to look at the media response only looked at the Wall Street Journal article about Powell's speech and how the market reacted. So I'll note that S&P 500, if I remember right, it might have been the Dow, up 1.5% in the wake of Powell's speech. And then the characterization of the article is the market saw Powell's speech as validating, I think they used that word, validating their expectation of a rate cut in September. And you're saying, if I hear you correctly, no, it wasn't that strong because it still depends on key statistical reports that come in and what you hear
Absolutely.
informally from the many contacts. They're not just you, but the other regional Fed banks. That's part of your job. You're out there talking to people all the time.
All the time.
Trying to supplement the hard data with the soft information.
Especially at a turning point or a transition point in an economy. If you only rely on the hard data, you're often behind.
You're behind the curve.
You're behind the curve, so you have to reach out. You have to talk to businesses and communities and workers. We're doing all of that. And as we do that, we're going to put all this together and go to the next meeting and ultimately make data-dependent policy decisions that I think, again, the chair laid out nicely how we think about it, laying out our reaction function, not a preset plan of how we'll act.
So, but it does seem, you can tell me if you disagree, it does seem like the way the market reacted to Powell's speech, which, as I said before, looks like they interpreted a part of his speech as validating their expectations of a rate cut in September. If that doesn't happen, making an even already politically challenging environment more politically challenging. And I understand that the Fed is not looking at the politics when it makes its decisions, but nonetheless, nobody likes to get the kind of heat that the Fed has been under recently. I just wonder what you think about that.
Ultimately, the way that we've always worked, and I think the way that we should work in maintaining what Congress gave us in our independence is do the job. Do the job well. Hold yourself to doing the job. If it's challenging, well, that's what we get asked to do. That's what we get paid for, so to speak. But ultimately, it's the privilege of serving, and it's the responsibility of serving. So we'll make the decisions like we always do. And I think the chair conveyed that in the speech.
He was very forceful.
He was forceful
on that point.
And I think each of us who sit around that table come in with an understanding that we are charged with a job. We have to do that whether we're popular or not popular, we're getting pressure or no pressure, and we have to just make the decision that is right for the dual mandate goals we've been given.
Right.
So I am thinking right now about the data, the people we talk to, the businesses we talk to, and how to best get to that price stability, full employment nexus that ultimately we call the nirvana. That's what people want. They want to not think about inflation. They want to not think about the job market. They just want to have their careers, raise their families, work in their communities.
Right. Your job is to pursue your mandate to the best of your abilities, ignore the political noise. That's what you're set out to do. But it's the communications is also there. The communications about what you're doing, why, what you're trying to achieve, how you assess your own performance. That's still a challenge.
It's always a challenge.
It's always a challenge. Maybe more so now than most times, but
maybe more so now. But my own assessment is that the reason it's harder now is because our goals are in trade-off, not because we're facing political pressure. It's really because we have above target inflation and a labor market that we don't want to see falter. That's always hard to convey to the public when we're in for the listeners, when we're in the divine coincidence where our one tool serves both purposes well, that's a wonderful place to be. We're not there.
So we're in one of those times now where the full employment part of your mandate is in some tension with the price stability part of your mandate. That's what makes the job harder.
That does make the job harder. But again, we're up to the task. That's central banking. That's being a policymaker in any central bank and at the Fed. And we're up to the task. We're resolute to get both of them done.
Okay. Well, on behalf of all the workers and consumers and employers in the economy, good luck in doing your job well.
Well, thank you very much.
Thanks, Mary. It's been a pleasure.
Mine likewise.